Hello friends, a very warm welcome to my channel. In today's video, we are going to talk about a company called Dixon Technologies. So this stock has been one of the biggest multi-baggers in the last 5 years. It has created huge wealth for its investors. We have spoken about this company earlier in our videos also. So this is a short video in which we usually talk about the stock at the current valuations. If you're new to the channel, please do subscribe and hit the bell icon to get updates of all the new videos that I upload. And if you're not a part of our Telegram channel, do join today by clicking the link in the description so that you join the correct Telegram channel. Every day morning before the market opens, I share my views on the market. I also share some portfolio allocation strategies which will help you increase your returns. So let's begin the analysis of Dixon Technologies. This will be the flow of our discussion. We'll talk about the business model in brief. We'll look at the stock performance in the last 5-10 years. We'll understand the main financial parameters. We'll understand why the stock has given such a big rally in the last 5 years. What is the outlook of the management going forward? How are the valuations at present? What are the risks of investing in this business? And then form an overall view. So Dixon Technologies was started in 1993. It is an electronics manufacturing services company. So they manufacture electronic products on behalf of the other brands. So they manufacture mobile phones, laptops, tablets, home appliances, refrigerators, televisions, and all the known popular brands which we use in daily life, get them manufactured through Dixon and sell it under their own brand name. So earlier all this used to happen in China, and gradually with Make in India and China Plus One, the manufacturing base is shifting to India itself. And Dixon has been a front runner in this theme, and it has benefited a lot in terms of the Indian manufacturing sector. In terms of size, it is one of the largest players in India in EMS. They do both ODM and OEM. So when you say OEM, it is all the specifications and designs are given by the customer. They do the contract manufacturing and hand over the product. When we say ODM, they do the design development of the product in-house and then offer the prototypes to the customers. They approve it and then they do the manufacturing in bulk. And that's why they have 3 to 4 R&D centers of their own. They have multiple manufacturing units for different products across India, and they are also eligible to participate in the various PLI schemes of the government, and they keep getting benefit of that. In terms of the product distribution, mobile phones contribute the highest. So the mobile and EMS theme, which includes all the accessories and tablets and other things related to mobile, constitute almost 80% of the business of the company. About 12% comes from consumer electronics. Home appliance constitute about 4% and other lighting products around 2%. If you look at the stock performance, until COVID, there was not much movement in the stock. But post-COVID, as the manufacturing started increasing in India, it gave a massive rally and crossed almost 18,000 levels. And even now, the stock is moving around in the all-time high zone. As you can see on the screen, the stock has generated almost 10x to 20x returns in the last 4 to 5 years for its various investors. When you look at the financial performance in the last 5 years, in FY21, the company did a revenue of about 6,500 crores. And in the trailing 12 months, they have done almost 27,500 crores. So it is more than 4x revenue growth in the last 5 years. The last 5 years, CAGR growth is almost above 40%. In the trailing 12 months, they have doubled their revenue. At this size of the company also, if they are able to double their revenue, you can understand the tailwinds in the sector. Profit has also grown in a similar fashion. The EBITDA was about 290 crores in FY21, which rose to almost 1,000 crores in the trailing 12 months. So this is again more than 3x. Margins in this business are less because they are contract manufacturers. So the EBITDA margin is stable at somewhere around 4%. If you look at the segment-wise growth, the major contributor to the growth of the company is the mobile and EMS segment. It is 80% of the revenue, and it has grown more than 200% in the first half of FY25 compared to the last year. The consumer electronics in the first half has not shown much growth. Home appliances have shown a slightly better growth at about 20%. Lighting products have grown around 14%. So from this, you can clearly understand that the mobile and EMS segment is driving the growth for this company. In terms of other financial parameters, the company is working on a net negative working capital, so which is very good in terms of the cash flows of the company. They have generated a high ROC of almost 30%, which is very good in terms of an investor's perspective. But the promoter holding is just about 32-33%. So if the company wants to raise equity capital going forward, there is a risk that the promoter holding may go down further. Now, what led to this massive rally of 10 to 20x in the last 5 years? There is a consistent growth in sales. The company has grown by more than 40% CAGR. The valuations have undergone a good re-rating, which led to the rise in the stock price. And these themes like China Plus One for the global manufacturers to Make in India have led to massive tailwinds for this industry. Now, what is the outlook of the management going forward? They are coming up with a new manufacturing facility for mobile phones. The existing 4 facilities are almost fully used. They have recently acquired 51% stake in a company called SMR2. They are also into mobile manufacturing. This will further add to the growth of the company. When we talk about the newly onboarded brands like Motorola, Techno, Infinix, the company says that they have good order book from these brands. They are going to add another global brand called Compal in this segment. They have done a tie-up with HKC recently to manufacture the screens in India or the displays in India itself. So they are now getting into the component manufacturing also. This is kind of a backward integration. They are expanding their manufacturing facilities or capacities in refrigerators. They are starting new products in home appliances like deep freezers, mini coolers, wine chillers. So the company is growing in terms of addition of capacities and they are diversifying in terms of the product range also. They've onboarded IKEA as a new customer in the lighting segment. The telecom and networking segment is also growing pretty well compared to last year. They are giving a guidance of 3 times growth in this year, FY25. And they are starting manufacturing laptops and tablets for new companies like HP and Asus. So out of 5 top laptop manufacturing companies, 4 are Dixon's clients now. The company is still open for various tie-ups and acquisitions going forward as it is at a stable cash position. So you can clearly see that the growth path going ahead is also good for the company. Now when you look at the valuations, the stock is trading at almost 192 times the earnings, which historically, if you see, this is around the peak valuation which the company has generally got. In terms of price to book times, it is trading at almost 48 times. Market cap to sales appears to be low because this is a low margin business. So valuations are definitely not cheap for this company, and the re-rating in the P multiple is already done. Further re-rating from these levels seems to be very difficult for a business like this. Now, what are the risks of investing in this company? The technology in all the electronic products keeps evolving, so they have to adapt with the new technology. Otherwise, the manufacturers or the brands would not prefer to make it in Dixon. Competition is increasing. The existing players are adding more products. The new players are coming at a smaller level, so gradually they'll start eating away the market share in small bits and pieces. If there is an industry-wise slowdown that could impact the business of this company majorly, valuation-wise it could be a risk if somebody is taking a fresh entry at these levels, and promoter holding is slightly less, which is about 30-33%. So now that you've understood the business model of the company, more details of the business model can be found in the earlier video on our channel. You've understood the growth aspects, you've looked at the valuations, financials, the risks of investing. Now what is our overall view on the stock? If you're already holding the stock and you've made good money at these kind of valuations of around 200 times the earnings, the further re-rating from these levels doesn't appear to be so easy. So there is no harm in taking off some profits off the table if you have made good money in the stock. But if you are looking at a fresh entry at these kind of a multiple of 192 times the earnings, unless you're a very aggressive investor, it doesn't look at all as a value buying opportunity. So it is always better to keep such stocks in your watch list and keep tracking them until there is some correction in the market and the valuations become more reasonable. So that's about Dixon Technologies. I hope you like the crisp analysis. I've tried to cover all the important points in the short video. If you like it, hit the like button and subscribe to the channel. If you want me to make videos on your favorite stocks, do mention the names in the comment section. Even this name was picked up from the last video's comments. Do join our Telegram channel by clicking the link in the description so that we can be in touch on an everyday basis. Thank you for watching and have a wonderful day.